I know I'm really excited about this. It kind of is a panel that pulls together all the themes that we've talked about today. So a really great group here. We've only got 30 minutes, so we'll try to cram as much in as we can. But I want to start by setting the scene and talking about where we are right now in wealth management and in terms of the disruption that's happening in the space. So Hardeep, do you want to kind of kick that off and talk about what you're seeing here?
So it's been an amazing event, and it kind of ties together a lot of things we've been talking about today. A lot of the work we've been doing is really reacting to this tectonic shift. One of the big things challenging the large firms, we're an interesting company because we are a disruptor, one of the small companies, but a lot of our investors are the traditional Wall Street firms. And 80% of people's customers base, the large firms, are going to change over the next 10 to 15 years. And the question is, what is going to happen about it? And when we look at innovation and disruption, those are very dangerous words. There's a lot of incremental innovation. There's not as much disruptive. I know the media loves to hype up. And the way we see the world orientated itself around is really three centers of innovation. Innovation one is around the next-gen advisor. And you've got robo-advisors and a whole set of innovation that happens around that. But there are also innovations around what I call product 2.0, the next generation, what mutual funds, what ETFs have done to mutual funds is a really big innovation. And that's one of the areas we play in. We try to be the next-gen ETF. And then there's this innovation around data. It is insane. I mean, we build these thematic indexes, but it's not just that we build the indexes. We have a motif called Obamacare, right, for example, and we have a repeal Obamacare too. We're nonpartisan. And one of the amazing things about this is not only can we look and see what people are buying and trending in their sentiment, but we can tell you what rich people, poor people, young, old, Democrat, Republicans, what they really think about their sentiments to Obamacare by where they're putting the money. But we've gotten to a level of data where we can even tell you what Peace Corps volunteers think, doctors think, people who listen to classical music versus people who listen to rap music. That is the kind of data innovation. So you've got these three innovations really going on, and it's all tying together. And I think there's this big discussion that I'm sure we'll get into of what are the big companies doing? What is truly defendable competitive advantage? You've seen Schwab, Vanguard start to do some interesting things in this space to compete with some of the smaller players. And it's interesting. It's kind of like The Empire Strikes Back. We're in phase 2 of the Star Wars trilogy. And we're seeing a lot of, and not everyone's going to survive. And it's actually an exciting, scary, and thrilling time to be in this space.
I completely agree. And I want to get to some of those disagreements today and see where your predictions are. But nobody has traveled farther to be on this panel today than Mark. He said he traveled, I think it was 26 hours coming from Sydney. Yep. So Mark, I would like to see if you could give us kind of a global perspective for what's happening in the wealth management space and what you're seeing. For people who aren't familiar, Mark is with BT, that's the full-service arm of a traditional bank. He's based in Sydney in Australia. So talk about kind of what you're seeing there.
Yeah, look, the Australian market is different in many ways, and it lets us actually sit back and watch what's happening here a little bit at the moment with great interest, and all your points, but really pointing it to us. We have a little bit more time on our side because the market's different in a couple of ways. And the first way that really stands out is our compulsory superannuation, which drives a lot of the investment in the Australian market. So 9.25% of everyone's pay packet gets put into retirement savings funds and invested for their future, preserved until they retire at a tax-effective rate. So what that forces is a huge investment pool that starts to grow from every part of the population. Added to that, we actually then do personal protection, whether that's life, income protection. Those things can be done inside or outside of super. Then you've got your normal investments, which we're talking here, all sorts of different platforms and vehicles that are inside and outside of that tax-effective environment. And what that means to us is that a robo-investing or some of those disruptors will take a little bit more time to deal with the complexity. And that complexity is where still our clients and the population by and large are still looking towards our advisors for the relationship. And there's definitely some self-directed parts of our audience, but there's still a large part of our customer audience who are looking for advice and need, whether it's just a bit of collaboration to help me get through the difficult parts, or whether it's I want to delegate the whole process to someone because this is just too hard for me. And in that way, one of the big challenges we've been facing into, which has been touched on a couple of times today, is trust. And trust in the advisor network. And there's something that we've, I wouldn't say experimented in, we're boots and all in, but I think it will be hopefully of interest to you guys. We've invested in the idea of ratings and reviews, but not of products. And there's been a few of those discussions. Actually ratings and reviews of our advisors. So we've launched a website that actually puts all of our advisors in the public domain, and customers can go on and rate and review the individual advisors. And we actually reach out to our customers to do that. So every time they see the financial planner, have a review, any of those checkpoints you'd be familiar with, we send out an automated EDM, so it doesn't come from the advisor, and inviting the comments and the feedback, then that gets published live onto a website. And I think linking through to the focus on millennials has been touched on here a couple of times as well, using their social networks. What we find is that their social networks may not have the relationships with advisors that they may need to tap into. So we're provided an environment where they can look at people like me, what did they say about this advisor? Did they meet my needs? Did they explain things to me in the right way? And that's very much about our brand values, about transparency and honesty and putting our money where our mouth is. And that is going a long way very quickly for us in terms of addressing some of what has been the problem around trust of our sector. Certainly has been difficult. As you imagine, I can see a few nods in the room of, wow, that would have been difficult. But there are things that I think require leadership to come over. You've really got to have a mandate to say it's in the customer's best interest to know this information. And you have all these kind of byproducts that happen along the way. So one of the nice unintended consequences was effectively a community self-regulating our advisors, because there's comments about them. If we start to see advisors with a range of comments, we've got the best mechanism we could possibly imagine to get feedback around their conduct and their performance.
And I think that's fascinating. The idea of kind of treating it like a Yelp for advisors, or treating people, of kind of reviewing them, it's really fascinating. And so, but it speaks to kind of the different models that we're seeing now, the different kinds of innovations. Something Rachel has been thinking about a lot, right? Tell me about inside Wells Fargo. What are these different models that you're kind of addressing, and how do you think the space?
Right. Well, Wells Fargo, as many of you know, is a very large bank. We actually do business with 1 in 3 people in the United States, which is pretty amazing. Through our investments, our investment wealth management business is the 3rd largest in the country, all the way through to the community bank, which we've got 9,000 branches and 14,000 advisors. So we're really big. And as you can imagine, being in a big company, and those of you who are sitting here from big companies, it's hard to innovate in big companies. But we're trying some different things, I'd say, on smaller scales and seeing what may play out. We heard a lot about millennials today. In our community bank, there's a lot of work we're doing digitally around doing things, making things incredibly easy. Technology innovation around texting and real-time balance information and other things without having to log in. ATMs that you touchless ATMs, you don't have to punch in a code. You can go to the ATM and either use a fingerprint or use your phone to get your money. So these are some of the innovations that we're trying. Not on I'm describing things that are maybe not on a large scale. Within the business that I'm in, which is our wealth brokerage and retirement business, I'm sure Mandell will touch on this. We're trying some different, and John Thiel talked about it. We're testing out some different advisor models. We have a tried and true relationship-based model in our brokerage business that works really well and is highly valued by, by baby boomer clients. We need to bring a lot of great new digital capabilities. I mean, the technology companies are certainly setting the bar. So we have innovation and capabilities we need to bring to bear to continue to strengthen those relationships. But we have a very good core business there that we obviously want to keep and evolve over time. But how do you get to other segments and demographics? Through an advice model. So we're trying some non-commission-based models, pairing non-commission advisors with commission advisors, both for transfer purposes, because advisors may want to retire at some point, but also to provide resources for the next generation and to provide a model that can support the next generation. So that's some of the things we're trying. We're also empowering our financial advisors to do some work around social media. We're going to be ramping up We hope to get up to 1,500 financial advisors using social media. Not every financial advisor is going to use it, but we're highly regulated, so putting in place the right infrastructure to support that has not been a small endeavor. But how do we empower our advisors, those that want to embrace it, to engage in a more collaborative, community-oriented way with their clients and with prospects of all ages and demographics? We also have different models of delivering brokerage, not just the full service model. We have a self-directed offering as well, and that's something we're certainly going to evolve. We're carefully watching some of these automated investing capabilities. One could argue that we already deliver that through a managed account platform with an advisor. So we have a lot of capabilities to deliver those services. It's just how can we maybe leverage some of that to do it in a way that's has different price points, positioned for a different audience, with a great interface and experience, in probably a more direct to the consumer or user-friendly way.
Yeah.
So those are some of the things that we're looking at and thinking about.
Fantastic. And I think so this idea that we're going to see the biggest wealth transfer we've seen in history, $30 trillion at stake as baby boomers pass down their assets to their children, everybody else too. Man, you're seeing this. You're seeing this at Morgan Stanley. Talk about how you're trying to get your arms around this. It just seems like we're on a panel here. It's got the new players, the old. How do you think about engaging the baby boomers plus their children and everybody else too?
Yeah, it's a fascinating topic, and obviously there's a tremendous amount of debate around it. I think at times it's a little sort of overblown in terms of what's going to happen with the $30 trillion in terms of whose hands it ultimately will end up in, because when you actually unpack the $30 trillion in terms of who the holders of that capital is, it's typically with high net worth investors, and then the inheritors of that wealth. We like to believe that there's still going to be a heavy dependence on the human capital. We think, and I don't say that from a point of hubris, because I think what some of my colleagues are doing on the technology side is absolutely fascinating, and for us to ignore that would be nothing short of, again, being quite arrogant. So clearly the digital capabilities that we're going to talk about here play a meaningful role there, but the bet that we're making, Morgan Stanley made it quite clear, our position here in 2009, we did the largest transaction, if you will, merger in the history of this industry when Morgan Stanley and Smith Barney came together. And so 16,000 financial advisors, we fundamentally believe, very much like our physical health, that your financial health, while technology can be an enabler to our advisors, and that's how we sort of think about digital, how can we enable our advisors to provide better advice for their clients, and how can we leverage technology for them to engage in a more efficient way with that would-be client that has a real interest in engaging them vis-a-vis technology. So let me give you a real-world example. So we have this piece of technology in our system called Insights Engine. And effectively, it's an algorithmic-based sort of platform that sits inside the FA's desktop. Think artificial intelligence, more specifically think Netflix, think Amazon. So as our clients transact, and based on the portfolio construction of that client, our advisors on a daily basis will be getting recommendations for a client. So it's a very prescriptive approach in terms of providing advice to clients. So that's a piece of technology that we have today that we think are going to put our advisors in a better position to provide, again, better advice for the client. And then I think about all the things that we're doing on the social media side that will, again, position our advisors to, again, be able to meet that client or prospective client where they ultimately want to be from a technology perspective.
Interesting. So let's throw the Eli. So you are working at Betterment, the largest of the robo advisors in terms of customers. Tell me a little bit about how you see this. Are robo advisors in the future? Are we going to be working with humans? How do you kind of see what do you see the relationship between the small brands and the big companies? And I would love some of the others to weigh in on this as well.
Sure. So I agree. It really is about how do we use technology to help all investors of all kinds get better outcomes. That's really where we see our focus. People have goals, real goals, and how do we get them to those goals? And you can innovate around products, create more different portfolios, and you can innovate around the types of tools that advisors have. So at the end of the day, we're really thinking that people are fed up with giving lots of investment options, but not a real solution to get to the end goal. So that's where we focus. That's where we spend our time. And in some cases, that means that investors want to really self-serve, but they want to self-serve in a different way than they've traditionally self-served at a Merrill Lynch or a discount broker consumer, they want advice, and how can I have that advice in a digital format because I don't actually want to call somebody, I don't want to go to somebody's office, I just want to get the right guidance along the way, and we provide that, and we provide that to 85,000 something customers, but a lot of times it's also about how do we enable advisors. So we have a Betterment institutional product and line of business as well, and that helps advisors take advantage of all the things that robo-advisors are bringing to market. So better portfolio management is part of it, better financial planning is another key component of it, as is accessibility and immediacy and building a new platform so people can really get to their investment end goal and get on with the rest of their life. So we give those tools to advisors, we give them to people directly.
I give you an example. Like I actually use, it's a competitor, a direct competitor of yours, Personal Capital is an aggregator technology that I find it's fascinating. So I use it even though I'm sitting inside of Morgan Stanley, don't tell me financial advising. But it's a great piece of technology that sort of pulls together in one location my entire sort of balance sheet, and it updates on a real-time basis. It's very transparent. It's incredibly easy to use. And then there's a voice component where there's an advisor from the Bay Area that's oftentimes calling me. I don't take that phone call. But my point is, again, the work that folks like Betterment and Personal Capital are doing is just nothing short of fascinating on the technology.
But I think we're asking the wrong question. It is not man versus machine.
Right.
It is a difference of high tech and what degree of high touch do you want. So, I'm a software bigot. I spent ages at Microsoft. And I think software will solve a lot of problems. World hunger will be solved by software because it's a distribution problem. But it is very hard to give tailored financial advice. And so when we look at any degree of complexity, software is not there yet. So we've seen models. We cater to institutions. We cater to individual investors. But it isn't this man-machine thing that you read about in the media. It is everyone's going to use high tech across the board. And then the question is, what scenarios do you want to add high touch layers on? So some that are purely automated, very simple models, yes, you can roboize it if there is such a word. But as you get more sophisticated things, the technology model has to change. But this notion that the advisor is going away, we made a strategic decision very early on saying this model is very, very hard to replace the human touch. Yes, there are segments of the population that want to do that, but en masse people want someone, their therapist, a lot of things helping them through that. And then the notion of advice is very, very hard to do. So it really is tying these three things together. And then the big problem with a lot of the investing models today, I'll give you a funny story. My wife and I, we love each other dearly, but we are completely opposite. She grew up spray painting people who wore fur coats, and I'm a little more right of center. And when we sit down with an advisor, they sit down, they do their suitability assessment, what's your risk model, and we're roughly the same age, although I can't believe I just said that. And when we sit down, we get a portfolio allocation. Now the problem with that portfolio allocation is I grew up in oil country. And so you talk about something like shale oil, I love it. My wife would have a heart attack if you put shale. And most people don't know what they're invested in. So when you go back to, this is not something that the big guys can solve, it's not something that little guy, it's something that we have put a big focus on, which is people care about what they're invested in. Most people would be livid to know that they've actually invested in war crimes. Right. Why? Because the big fund companies buy cluster bombs. They would be livid. The California State Treasurer wrote a letter to CalPERS saying, why are we investing in guns when we as a state don't believe in that? So there is so much room for innovation. And for me, this notion of disruption is a very dangerous word because we throw it out a lot in Silicon Valley. There are very few models that are truly disruptive. And that has to do with the business model. But there is so much work to do for the big guys and the little guys to take a simple problem as like, I don't know what I'm investing in. And that's something that nobody is solving. We've been focused on that.
Perfect. Rachel, how do you respond to that? You're representing some of the bigger players.
I would say it's not either or. And I think there's some consensus around that on this panel. It's not either or. And in fact, what we've found is up to, it's between 30 and 50% of our full service clients who have advisory relationships also have self-directed relationships and are soloists, if you will, for part of their portfolio or within a marriage too. So it's not either or. And What I find exciting, I find the innovation exciting. First of all, I think it raises the bar, and it for those of us that are in large companies, it elevates our conversation, and not just from like, oh, Amazon's great, but some really viable competitors are out there that are doing some really interesting things. But also it gives more options to the investor. And if there's anything we learned today about the millennial is it's a very engaged group, and it's a highly educated group, and it's a group that really wants to get involved. So, that there may be different things we do for the benefit of the millennial. That's also going to, whether it's education or certain types of investing capabilities that we can make available either through advisors or to other segments. So certainly when I'm sitting in a place at Wells Fargo where there's such a large range of customers that we have, from people just starting to extraordinarily wealthy people, I love the fact, makes it complicated for a marketer and for a brand, but I love the fact that there's many different ways we can potentially serve customers, and we can't do every one of them really well, but it's certainly something that we're thinking about exploring, and I think we hit the mark on a number of them already today.
Yeah. And look, I'll just add to that. I agree with that comment, and there's also some other great benefits that come with this. Obviously, it's improving the customer experience exponentially and forcing advisors to enhance their customer experience as well. But it's forcing us to digitize our business, and that actually brings cost efficiencies, and it also reduces risks, and we didn't want to talk about that earlier today, but many of us are facing legacy systems with back-end processes that have people involved at many steps. And when you're staring and facing into a regulator that's asking you to have customers' best interests at heart, not make any mistakes on disclosures, all those pieces, when that process is digitized, you're reducing your risk for your business. And so I think the cost, the risk, and the customer experience become a really holy trinity for us as an industry.
Well, I think Mark's saying something really important, which is, I think most people have this impression, and it came over dinner last night as well, that the big guys don't get it. I think the big guys get it. Everyone sees the same data. They see the opportunity of this wealth transfer. The hard part is, how do you move a supertanker? So we did a deal recently with Pacific Life, and it was all about impact investing, targeting the millennials. And we had an interesting conversation about, wow, you've got this big supertanker. And they said, it's going to take us 10 years, so we better start going now. And we're doing some interesting work with them. So I think it's more about the ability to execute. Regulatorily, it's harder for the big guys. From a technology perspective, the legacy issue puts them at a huge disadvantage. And so the innovators have an advantage. And the job of the little guy is obviously to execute, move faster, quicker, adjust your model so you don't get stamped on by the big guys. What's nice is actually a lot of people say the same thing. It's just, how are you going to act on it? And that's the advantage that the little guy has.
Well, but you talked about, we were talking earlier, you were saying you spend 30% of your time just on regulation. And right, so we talk about innovation, we have to talk about regulation as part of this. So, I mean.
Yeah, so when we applied for FINRA membership, I remember getting a letter in the mail, and it said, congratulations, Mr. Walia. We're considering your application, and we're going to put you on the new and novel list. And I went to my compliance office and high five, and she's like, no, this is really bad news. In financial services, you want to be old and boring from a regulatory perspective. And so for us, I do spend 30% because, full disclosure, I'm very active with the regulators as well, helping to think through new technology, because there is one of the reasons you see so much innovation is because the regulators are letting it happen. 10 years ago, 5 years ago even, it would be really hard because they'd say, well, what is Motif? Are you a fund? Are you a brokerage? We don't fit. Do you fall under the 32 Act, the 40 Act? And so this notion of how do you work with regulators, the regulators themselves, I don't know if anyone has been following cards. You've got the regulators now, and I'm probably the only guy on the planet who likes cards, using data to help discover fraud. So you've got regulators using big data models, the same kind of innovations that we're using. So it is changing, and it's actually a good thing for our country, and it's an advantage also that they're open-minded. They're doing principle-based regulation versus saying, let's just follow the letter of the law, which is so hard for companies like ours.
I think also we should recognize regulators are actually excited about some of the innovation that's happening. They serve a purpose to get investors better outcomes and to protect them. And if you think about, for example, what's happening with the Department of Labor and an effort to protect retirement savers, they are looking at what technology and innovators can do to give retirement savers the advice that they deserve, impartial advice. And when they see that advice coming at really low, fair cost, they know that their objectives can actually be obtained.
Interesting. So we don't have a ton of time left, but I want to get from each of you to kind of do a crystal ball moment for a little bit. Where is this space going to go? What should we expect from wealth management going forward? Do you want to start us off? What's on your radar for the future?
I think in the final analysis, you still will have, and I said this earlier, just like, again, medicine, I think that you still will very much want an advisor who can help you think through the complexities that go far beyond just portfolio construction. I mean, if it's about stocks, bonds, cash, you lose. But when you start to get into some of the complexities of estate planning and some of the more nuanced things that are required, I think advice in the final analysis will ultimately carry the day. But you will have to be industry standard from a technology perspective. So from a digital standpoint, I mean, we are going to be charging really hard. Our head of digital is here in the room. We're going to be charging really hard on that front.
Interesting. Eli, what don't we understand about this space?
For the last couple decades, we've closed the case on the right way to invest. It's low cost, diversification, passive investing. Study after study says that's the way to do it. Now, how do we take the revolution of low cost trading, the revolution of cheap index funds, and build on top of that to make personalized, customized portfolios and management to really reach the unique goals of each individual? And we can use technology to solve for that, whether it's working with an advisor or working directly with the technology.
Rachel?
I'm an optimist. I really do believe that for some clients, there's always going to be a tremendous need for advice. I think about huge moments in my life with my husband and my family where our advisor has made a life-changing difference for us. I can think of two off the top of my head. So I know there's a tremendous merit to it. At the same time, there's a huge need for people to invest, to save, and I think some of the innovation, the democratization, the transparency is going to provide more offerings to a wider range of investors and get people started potentially sooner, especially if you think about the millennials. So I believe, I'm a huge believer in advice. I think it's here to stay. I think the transparency and technology is going to make it better. And then I think these other models are going to help fill in some of the gaps where we may not be serving potential investors as well as we could. And therefore, that's going to be better for those folks and better for us.
Mark, what should we be taking away from Australia? What should we be doing here in the U.S. That you guys have already mastered?
Yeah, well, I don't know if we've mastered any of those things. It's complex, and we can see it coming. The same debates that you guys are having are exactly what we're looking at right now. I think from my perspective, I concur that this is going to be part of a spectrum of offerings because we just see different customers want different levels of engagement depending on their sophistication, all those kind of things. So I think it'll continue to enhance and lift the standards in wealth management significantly. I think we're at the start of a real lift there. But I think ultimately the people who are going to win who are the people who are closest to the customer. And so either way, whether it's your advisor or it's your platform, it's who's anticipating your needs and adjusting for you, who's coming to you with offers, who's actually getting in front of what you're asking. And I think the conversations we've had around data on today will be really where it actually gets to in the end once the technology landscape has settled itself back out.
Hardeep, we've got a room full of people in this space trying to make sense, trying to get some answers. What should we take away from this panel and everything that's going on in the industry?
I think friction is going to go to zero. Transaction fees are going to go to zero. And you're going to see the big guys compete with technology companies. I'm going to China in 2 weeks. And we're talking about the big players over there aren't going to be the traditional financial giants. It's going to be the Renren, JDs, Alibabas of the world. They're investing billions of dollars into getting in. You're going to see that companies in Silicon Valley, where we are, the bigger companies, start to say, wow, there's so much profit, so much opportunity. So you're going to see a clash of technology and the investing world. You're going to see fees go to zero. You're going to see a lot of things that we pay for today. Fee compression is going to be dramatic. And it's going to be about disruptive economics. It's not disruptive technology. When you can start cloning funds that people pay 200, 300 basis points, we are doing that right now, and charge zero and make money, that's the kind of innovation that will get people scared, and it's going to force a lot of business models to rethink the essence, the economics of their business. And so I think we'll see a lot of this, especially the tech side, globally first, because of how our markets do have nuances and regulatory issues, and the regulators internationally are doing interesting stuff. But I pay attention to the economic model of this industry.
When we go to
it's gonna
zero,
change.
yeah, it makes a big difference. Yeah, great. Do we have time for one or two questions? Great.
So this morning, I don't know if you guys were able to hear Mohammed from PIMCO. Mohammed from PIMCO, talk about the
No
risk
longer-
the
it's
risk
no longer
in the
there
market.
anymore, I don't think.
Yeah, formerly from.
Formerly at PIMCO, yes.
Right, formerly at PIMCO, right, and Harvard and all the rest. So talk about the market gap, the gap between the growth in the public markets and the real economic growth, which we know is extremely meager all around the world. So how are you guys prepared to deal with another, let's say, a mini crash, or as they say in Australia, the GFC, a mini GFC that would wipe away a lot of wealth, and a lot of these nascent investors who come in, or the millennials as we're calling them, how do you prepare to deal with that and from a marketing perspective?
That's a great question. Mandell or Rachel?
You go
you go,
first.
Mandell.
Okay. Well, I think the approach of our advisor force, and we've been pushing this for some time in terms of moving away from a index-based sort of approach to sort of portfolio construction and basically determining are you adding value or not based on how you're performing vis-a-vis the market, and moving more towards a goals-based sort of construct. So meeting clients where they are in terms of their risk tolerance, what the allocations ultimately should be, based on income needs that they have, based on time horizons and all the things that are truly bespoke to said client. For so many years, we've all been, how's the S&P doing versus how am I doing versus the S&P? And we just think that that is the exact wrong approach, and it should be truly idiosyncratic to the individual investor based on where they are and what they're ultimately looking to achieve. So that's something that we're trying to scale across all of our financial advisors. Obviously, to do that across 16,000 folks is a very difficult thing to do, and it moves at glacier speed. But more and more of our advisors are embracing this planning-based, total balance sheet-based approach, and not just thinking about, again, simply stocks, bonds, and cash, because I do agree with the point that that's going to zero. And in order for you to win from an advisor perspective, obviously, you got to be paid you're going to be paid on your advice for everything. But from a protection perspective, is you got to be making sure you're building portfolios and giving advice based on the true goals and objectives of the client as intuitive as
it's actually going to be. I mean, fortunately, a lot of the asset classes are so correlated now that becomes harder and harder to do. So we all grew up saying you can either eat well or sleep well. Right. Yeah. What we're doing is we're actually rolling in hedging models. You have to go in and actually have people going, and that's faster than any advisor can do because this market is driven by algos, and you're going to see algos actually go do the work. What's sad about that question is people don't realize how massive this industry is. 2008, $8 trillion of average American wealth just evaporated. Right. But that was not the tragic part. The tragic part was the industry, us here, got paid $376 billion in fees that year. And that's the part that you're going to see go in, and what's going to happen is that is our number one game. As a young startup in this space, the biggest risk to any business model here is the market collapse. So we are obsessed about hedging models, and we're in this really interesting time because it's not just this long-term portfolio. You get into behavioral economics as well, but it is this notion of how do you actually use technologies and algos to actually do the work for you in managing risk, and that's a very important part of this equation that no one's frankly cracked the code on yet.
It's huge. It's huge. I'd love if we have time for one or two more. Any other questions out there? This is a great group. Yeah. Pink, yeah.
Hi, I just had a specific question around ultra-high net worth individuals and what your thoughts are in terms of, obviously in this very high-touch environment that they are being worked with by their advisors. How can technology help there? What are the gaps that technology can fill in that specific market space?
Yeah, Eli, or Rachel, go ahead.
No, we've got a lot of ultra high net worth clients. And actually ultra high net worth clients, while they, we serve them with a team. I'm sure that's a pretty typical model. You can't just have one advisor supporting that. There are so many needs. Ours includes psychologists actually too, which is interesting. Their expectations around digital are as high or higher. These aren't people that are whiling their days away Googling stuff all day long just for fun, but they're very sophisticated and they're being provided services by very high touch, but also very digitally sophisticated organizations. So they come to us very much so around advisor enablement and being able to have great connections between them and their advisor, but they also want us to be working with everybody else who works with them. So we need to have abilities to provide account access under, regulatorily and legitimately, to their tax accountants and other folks. So the digital enablement is the connection between the team and the client, and sometimes the client's other members of that relationship, but also with other key providers to that client. So very high expectations, and also, we need to invest a lot in the segment.
Eli, do you want to touch on this too? Because who is using these spaces? It's not just the mass affluent, right?
Yeah. So I was gonna turn the question on its head a little bit and say, we can do what's really beautiful about this space is we can do for mass affluent and really high affluent folks all of the kind of same things. We can optimize around taxes, tax loss harvesting, and picking the right lots, and as well as giving them sort of the access and the technology tools. People of all investment sizes want that, whether you're managing $50,000 with us or you're managing $10 million with us. People's demands around that are kind of consistent. But the beauty, really, I think, of what technology offers is what you once did only for people with $10, $20, $50 million, you can now do for people who have $1 million or $100,000 as well.
Great. I think that is all the time we have for today. This is a really, I think, a really interesting topic. There's a lot more to discuss here. Yeah. But how about a round of applause for just a terrific panel?
Good job, guys.
Great.
Pleasure.